Welcome to the debate. Today we are examining the state of the retail sector, looking closely at the incredibly complex economic and performance data that has poured in from late 2025 right through early 2026.
Yeah, and anyone following the industry knows this period has delivered some of the most challenging figures we have seen in a generation, really.
Absolutely. We are talking about severely declining footfall, hundreds of thousands of job losses, and honestly, a complete distortion of traditional peak trading periods. So, the central question we are unpacking today is how we actually interpret this data. Are these immense pressures simply the result of a temporary cyclical macroeconomic downturn driven by a cautious, inflation-wary consumer?
And this is the crux of it. Are we looking at something much deeper? A permanent structural shift defined by heavy automation, permanently altered consumer behavior, and a fundamental breakdown of the traditional retail cost model.
Right, and I look at this data and I see a sector undergoing an irreversible structural transformation. The old employment landscape and the traditional consumer calendar, they are simply not coming back.
And I look at the exact same data and see a very different reality. I argue that the sector is experiencing a severe, yes, but entirely standard cyclical contraction. We have acute macroeconomic pressures that are temporarily suppressing consumer confidence and delaying discretionary spending. It is a highly painful moment, certainly, but it is not the fundamental destruction of the traditional retail model.
Well, let's get right into the foundations of this, starting with my perspective. When I say we are looking at a permanent rewiring of the industry, the clearest piece of evidence is the employment data. It's not a temporary dip. The traditional retail cost model has effectively been rendered obsolete. I mean, over the past 5 years, the sector has shed a staggering 250,000 roles. Last year alone, 74,000 of those jobs just vanished, pushing the total retail workforce to a record low of 2.76 million. And when you look at the boardroom decisions driving this, it isn't just a cautious hiring freeze to weather a storm. It is a calculated, permanent elimination of human capital at the lower tiers.
Look, you're pointing to the raw job losses, which are undeniably sobering, but I think interpreting them as a permanent death now completely ignores the broader macroeconomic context we're sitting in. Retail is doing what retail always does, adapting to a highly volatile economic environment. Just look at the consumer psychology right now. We track the GfK Consumer Confidence Index, which, for those who don't follow it religiously, is essentially a barometer of how optimistic households feel about their personal financial health and the broader economy over the next year. It actually improved slightly to -16 in January 2026.
But -16 is still historically low.
It is, yes. And it dipped again to -19 in February, but that fluctuation perfectly reflects temporary, acute anxiety. People are dealing with budget jitters, mortgage rate uncertainty, and sticky inflation. It is not a permanent philosophical rejection of physical retail.
But consumer anxiety doesn't explain the boardroom response. The driver of these job losses isn't just that shoppers are nervous. It's the undeniable pressure of consecutive, massive minimum wage increases. We saw a 16% minimum wage hike for 18 to 20-year-olds in April 2025, and then another mandated 8.5% increase for April 2026. The traditional retail margin simply can't absorb that kind of legislative shock. That is why 61% of retail chief financial officers right now are actively reducing staff hours and pouring capital into automation. They aren't waiting for your cyclical economic rebound. They are permanently replacing entry-level tasks because the maths no longer works.
Consumers are behaving exactly as we expect them to in periods of uncertainty, though. They prioritize essentials. In December, food spending was up 3.1% year-on-year, while they aggressively pulled back on discretionary sectors, things like health, beauty, and fashion, which dropped roughly 8 to 9%. Crucially, the household savings ratio remains incredibly high right now. In fact, it's the highest we've seen since the pandemic. That tells us a very clear story. Consumers actually have the money. They are just actively choosing to sit on it and wait out the uncertainty. This is classic recessionary behavior, a cyclical adaptation that always reverses once macroeconomic stability returns.
I completely understand the theory of dormant consumer spending, but I want to pull us back to the reality of retail payroll, because this is where the structural argument really takes hold. You frame the job losses and high savings as a pause, a sort of defensive crouch for the industry. But if you look under the hood at how retail operations are structured, the fundamental incentive to hire, train, and promote human beings has been entirely dismantled. Think about the pay gap between a frontline store colleague and a shift supervisor. In 2020, that gap was a healthy 8,000 pounds.
Right. It provided a very clear trajectory for career progression.
Exactly. It was a tangible step up into the middle class, a reward for taking on the stress of opening the store, managing schedules, dealing with complaints. By 2026, because of the aggressive, disproportionate upward pressure of the national living wage, that gap has collapsed to a mere 2,100 pounds. Retailers are paying their frontline colleagues roughly 40% more than they did 6 years ago. But here is the kicker. Overall productivity rates have remained entirely stagnant. Retail productivity is effectively sitting at levels we haven't seen since the late 1990s or early 2000s. Retailers literally cannot afford to pay for human labor to perform non-value-adding tasks anymore, and the societal cost is severe. We are permanently locking out the 16 to 24 age bracket. We're looking at a devastating 16% unemployment rate for that demographic right now. That is not a temporary hiring freeze. That is a permanent, structural barrier to entry that has been built into the P&L.
I have to push back on that framing. I completely agree that a 16% youth unemployment rate is deeply alarming, and the wage compression you're describing is a massive headache for store operations right now. But framing this as a permanent lockout ignores the immediate acute triggers for these corporate behaviors. Look at what businesses have had to swallow over the last 12 months. This spike in youth unemployment is a direct symptom of severe but temporary corporate hiring freezes. The data shows that 45% of retailers expect to freeze recruitment. But why? It isn't because they've permanently solved retail with robots. It's because of sudden national insurance hikes. And just to clarify for everyone, we're talking about an immediate government-mandated payroll tax increase on employers. When a tax like that drops out of nowhere in a high-inflation, low-growth environment, companies are forced to immediately protect their bottom lines.
Which they are doing by eliminating the roles entirely.
They are executing defensive maneuvers. Yes, 55% are looking to cut head office headcount, and 42% are considering reducing store roles. But technology and AI are going to be used to manage back-end processes. That is an inevitable evolution of any industry. But human colleagues are still fundamentally required to manage the actual customer experience. Once the economic landscape settles, once interest rates fully stabilize and consumer confidence naturally thaws, retail will absolutely have to absorb younger workers again. Automation can count stock and optimize supply chains, but it simply cannot replicate the experience-driven, high-touch aspects of retail that drive brand loyalty.
I think your argument assumes that the customer experience is going to return to a volume-based model that requires that historical level of staffing. But if they are slashing staff to the bone, how does the industry actually survive its busiest seasons? Because if we look at the data, the traditional consumer calendar seems just as fundamentally broken as the payroll model. The conventional retail model always relied heavily on the golden quarter, those crucial months leading up to Christmas where retailers make the vast majority of their annual profit. But that model is effectively dead.
Dead is a very strong word.
It is dead. Black Friday has completely cannibalized Christmas trading. December used to be the lifeblood of the high street. Now it is turned into a month of mere stocking fillers. We saw a 7% drop in spending in towns and cities in November leading up to Black Friday. Consumers totally reined in their budgets for weeks, only to unleash a desperate, heavily discount-driven splurge over a 4-day weekend. And the inflation data paints a brilliant picture of this trap. In November, we saw 6% deflation in clothing and footwear and 0.3% deflation in furniture. This isn't a story of consumers just waiting to spend. This is a story of retailers trapped in a permanent, destructive cycle of margin-burning discounts just to clear out their warehouses. They are being forced to pull demand forward, sacrificing their profitability simply to maintain basic cash flow. The calendar is entirely broken.
I just don't buy that the calendar is broken. The shift in holiday spending is an incredibly rational adaptation to the current cost of living crisis, not the permanent death of the golden quarter. consumers are incredibly savvy. When their disposable income is being squeezed on all sides by high housing costs, energy bills, and general inflation, of course they are going to utilize events like Black Friday to stretch their limited budgets. That isn't a broken calendar, that is a rational consumer maximizing utility in a tough year. And if we look beyond the December gloom you're describing, January 2026 actually challenges this narrative of a permanent collapse.
January was largely propped up by inflation, though.
Let's look at the numbers. The British Retail Consortium reported a modest 2.7% increase in retail sales in January. Yes, it was driven largely by a 3.8% rise in food, which is essential spending, but non-food also saw a 1.7% increase. High street sales were only slightly down from a very strong comparable period the previous year. This shows that people are still actively participating in the market. They haven't abandoned the concept of retail shopping. They are just timing their purchases much more defensively. They held off for guaranteed discounts in November because they had to. Right now, not because they forever will. Once wages outpace inflation for a sustained period, that desperate reliance on deep discounting will soften.
You point to a 2.7% increase in sales, but we really have to look at the underlying mechanics of that growth, because it's a dangerous kind of growth. It is largely inflationary, and it's predicated on a decreasing number of transactions and a shrinking pool of actual customers. What we are seeing is that average transaction value, ATV, is rising because things cost more, but actual footfall is plummeting. And that brings us to the physical footprint of retail. The overall decline in footfall across the board is undeniable, and it is accelerating. We saw a 2.9% drop in December, which is supposed to be the busiest month of the year, followed by an even steeper 6% drop in January. Physical retail is consistently bleeding out, losing ground to a stabilized online sector that now comfortably accounts for roughly 28% of total retail sales and nearly 30% when we isolate clothing.
But footfall isn't a monolith.
No, but the casualties are mounting everywhere. Look at the high-profile brands we've seen recently facing severe distress. Legacy brands like Russell and Bromley, Claire's, and the original factory shop falling into administration, effectively declaring bankruptcy or undergoing massive restructuring. These legacy failures are potent evidence that large-scale physical retail, burdened by massive property overheads and outdated operational models, is fundamentally unsuited to the modern consumer landscape. You can't run a massive physical footprint when almost a third of your clothing sales have permanently migrated to the internet.
The destination data possesses far more nuance than a simple narrative of physical retail dying, though. If we actually break down that footfall decline you mentioned, a fascinating, very human pattern emerges. In December, yes, large regional shopping centers saw a severe 5.1% drop in footfall. However, traditional high streets only dropped by 0.9%, and retail parks fell by 2.5%. Even more tellingly, recent data indicates that small towns actually saw an uplift in spending, while medium and large towns decreased.
I'm not sure a slight uplift in small towns offsets the massive losses in regional hubs.
It doesn't offset the total volume, but it explains the behavior. This doesn't demonstrate that physical retail is unsuited to the modern consumer. It demonstrates a profound, albeit cyclical, shift toward hyperlocalism. Think about it. When consumers are financially constrained and worried about the national budget, they save money on expensive travel. They don't burn pricey fuel, and they refuse to pay 20 quid for parking at a massive regional mall. Instead, they walk down to their local high street. The physical retail model isn't dead. It is temporarily hyper-localized due to squeezed disposable income. And as for the legacy brands failing, the administrations of specific brands like Russell and Bromley or Claire's isn't an indictment of the high street concept itself. It's a reflection of those specific businesses failing to evolve in a highly competitive, cyclical market. There will always be churn in retail. New, more agile, hyper-localized entrants will simply take their place on those community high streets.
I hear your point about localism, and it's a nice thought. But even on the local high street, how do they make the maths work when their overheads are fundamentally the same? The economics of running a physical store have completely changed.
When you audit a store's operations right now, you find that general retail staff spend roughly 26% of their time actually interacting with customers. They spend 55% of their time completing non-value-adding operational tasks, moving boxes, checking inventory, processing returns, and 14% of their time doing virtually nothing. All of this while being paid 40% more than they were just a few years ago. That is a structural crisis. Automation isn't just going to take the jobs at the big, failing shopping centers, it's going to systematically eradicate those operational tasks on your thriving local high streets too. The localized high street you envision might survive, but it will require a fraction of the human workforce to operate.
A model that relies on squeezing a higher average transaction value out of a shrinking number of customers who are retreating to small towns just to save on parking, that is the definition of an unsustainable model. It's managed decline.
With that inefficiency, the fact that 55% of staff's time is spent on backroom tasks rather than the customer experience is exactly the opportunity for a recovery. It's not the absolute end of employment. When these macroeconomic pressures finally ease, the businesses that survive this crucible will have utilized AI and automation to completely streamline the back end. But rather than simply firing the workforce, the smart operators will pivot those human beings toward that 26% of time currently spent on the customer. They will train them to drive that average transaction value even higher through vastly better service, intelligent upselling, and genuine relationship building. The fact that consumers are heavily guarding their savings right now, maintaining high bank balances out of fear of job losses and pessimistic budget announcements, proves that the purchasing power hasn't vanished. It is simply dormant. When the interest rate cuts actually begin to filter through to people's mortgage realities, and when inflation remains steadily normalized, that defensive posture will thaw. People will want to shop, and they will want a premium human experience when they do.
The assumption that lower interest rates will be the magic panacea for consumer confidence is flawed in this new landscape, though. As the recent data shows, interest rates lowering to 3.75% hasn't sparked widespread joy. In many ways, it actually harms the very people who hold those incredibly high savings accounts, often older demographics, by reducing their yield. Meanwhile, for the younger demographics facing that 16% unemployment rate, a slightly lower interest rate is totally meaningless if they don't have the fundamental job security to take on a mortgage or justify discretionary spending. We literally saw house sales drop 5% between December and January. The gears of the wider economy are grinding because the structural foundation of retail, wage parity, career progression, predictable seasonal trading has been fundamentally altered. Retailers aren't waiting for a thaw. They are now permanently structured to expect less volume, and they are entirely dependent on protecting their tight margins through extreme operational austerity.
The flat productivity, and you see a permanent broken state of affairs. I look at those exact same metrics and see a market that has been profoundly shocked by aggressive legislative intervention, these massive minimum wage hikes, and it's currently experiencing the very natural friction of digesting it. A 40% increase in wages over 6 years was a massive shock to the system, but productivity will eventually catch up, precisely because of the technological investments being made in the background right now. Furthermore, your point about the golden quarter relies incredibly heavily on this year's highly specific timeline. Consumers held back in November almost entirely because of the looming national budget. They were spooked by political and economic uncertainty coming out of the government, so they hoarded their cash until the Black Friday sales guaranteed them absolute value. That is not a permanent rewiring of consumer psychology. It is a hyper-rational response to a highly specific, very tense political and economic moment in late 2025.
We have covered substantial ground today, and I think the lines of our disagreement are very clear. To summarize my position, the data we are seeing points to an irreversible transformation of the retail industry. The systemic cost pressures, driven largely by aggressive wage hikes that have compressed pay scales and eroded the fundamental incentive structures of the workforce, have broken the traditional operational model. We're seeing permanent behavioral shifts in the boardroom, evidenced by the heavy investments in automation designed to permanently replace entry-level roles, leaving us with a record-low workforce of 2.76 million. Furthermore, the complete evolution of the trading calendar, where Black Friday forces margin-burning discounts and cannibalizes traditional seasonal peaks, combined with the relentless decline in physical footfall and the shift online, shows a sector that has structurally moved beyond the models of the past decade. The old way of doing business is not coming back.
And to summarize my interpretation of the exact same data, we are looking at a sector exhibiting classic, albeit very severe, cyclical adaptations to a genuinely tough macroeconomic climate. The cautious consumer behavior we see reflected in the volatile GfK index, the strict prioritization of food over discretionary spending like fashion, and the historically high savings ratios. All of this demonstrates a consumer base waiting out the storm, not a consumer base leaving the market entirely. The shift towards local shopping and the temporary reliance on deep discounting are defensive maneuvers against high living costs. Similarly, the high youth unemployment and corporate hiring freezes are immediate reactions to specific fiscal shocks, like sudden national insurance hikes. As economic stability returns and real wages outpace inflation, this dormant spending power will be released and the sector will normalize.
While we clearly disagree on the ultimate trajectory, structural permanence versus cyclical recovery, there is a vital point of convergence in our analysis today that I think we both recognize. We both acknowledge that the retail sector is currently operating under historically immense pressure. Whether navigating a permanent new reality or weathering a severe economic winter, survival in this current period demands a profound focus on maximizing the average transaction value. Retailers are fighting tooth and nail to extract more value from an undeniably shrinking pool of active shoppers.
I absolutely agree with that point of convergence. The complexity of these economic indicators is immense. Whether we are parsing the nuances of hyperlocalism versus the decline of large regional shopping centers, or examining the tension between historically high savings rates and high youth unemployment, the data reflects an industry in the crucible. There is so much more to explore in how these businesses are actually executing on the ground.
The coming months will be absolutely critical to observe. As we move deeper into 2026, we will see whether these high-pressure adaptations harden into permanent structural realities or whether they soften into a recognizable cyclical recovery. As always, we leave it to you, the listener, to weigh the evidence, consider these perspectives, and form your own conclusions. Thank you for joining us.